Welcome, everyone. I'm just going to get us started. And so we are recording this webinar today so that clients that could not attend can see the recording, or any of you that if you have to leave early for any reason, you can join or you can watch the recording later as well. So I want to start by, again, thanking everyone for joining today's webinar and saying that the reason we've decided to do this, especially for our clients, is because we know that you understand our process in terms of financial planning and investing. But despite that, it's during turbulent times like the ones we are living today due to the economic conditions, and especially as a reaction to the United States tariffs, that it's important to stay the course. But it's not always easy. And so we think that by communicating with you and sharing why we believe what we believe in terms of the importance of a financial plan that guides your decisions and the decisions or recommendations that we make, and why an asset dedication strategy protects you, it's important to go over this and to refresh our memories, if we will. And we want to make sure that you also have a chance to ask us some questions. So we're going to explore today the benefits of sticking to your plan and how a long-term strategy, and specifically an asset dedicated strategy, helps us weather these turbulent times. With that purpose, we've invited Steve Huxley, although his name at the bottom says Brent Burns as well. But Professor Huxley is co-founder of Asset Dedication. He's also a tenured professor at the University of San Francisco and co-author of the book Asset Dedication. And he helps us here at TQM Wealth Partners help you through the research that he and his team do, along with Brent Burns, who is the other co-founder and president of Asset Dedication. And many of you have met Brent, but I think this may be the first time most of you are meeting Steve. So we want to thank you both, Steve and Brent, for being here today and for sharing some of your, not only your thoughts, but the real data behind asset dedication and the research, and giving us all more of a sense of direction, if you will, when it comes to staying calm when markets are as volatile as they are. And we know that that is the investment experience, but I think that it's when there's downturns that we forget that volatility is not only on the upside. So
Right.
with that, I'll turn it over to Steve or Brent. I'm not sure who's going to start, but please, I'll just mute myself, and thank you again for being here with us.
I think I'll kick it off.
Let me first of all apologize. I taught statistics for about 50 years, so if I start talking about standard deviations and things like that, Brent usually kicks me under the table, but he can't do that now with Zoom. So we'll have to get started. You just have to remind me to knock off the technical stuff.
But the technical stuff is the important stuff, really, in the research that we've done. And just to give you guys a little bit of background into asset dedication, as Marcel mentioned, Steve's a longtime tenured professor, award-winning, I might add. I was lucky enough to have him as my professor when I was in the MBA program a long time ago, and was his graduate research assistant. And we started asset dedication started as a research project, and has never lost that sort of core to it. We test everything that we do. We test it in the context of the plan, and that's one of the things Marcel mentioned that I think is really important. it kind of reminds me of when Alice is talking to the Cheshire Cat, and she said, well, you know, where should I go? And the cat says, well, where would you like to go? And she says, I don't know. And he says, well, then any road will take you there because you don't know where you're going. But when you go through the process, and TQM has they have a special process. I will say it is, I mean, a lot of people say comprehensive financial planning, but most people don't do comprehensive financial planning. TQM is over and above. They are great. They're really great on the intentionality of like, what do you want to do with your money and when do you want to do it? If you're retired and then your money needs to be your pension, your paycheck, and that's where asset dedication really, as we were doing the research years ago before the book, we were looking at every approach, at all the approaches that the institutions were using, and what we found that is in the context of the plan, pension-like approach, which is what the technical term for asset dedication is asset dedication. So, and there's some, it's usually included in a finance textbook. It's pretty esoteric way back on chapter, 700 on page 900. But it's in part because it's complicated to do. We figured out how to do it for people. But everything that we've done, we've always tested in the context of the plan, because that's how people end up having to spend their money, right? They have, sort of the outline of what it is that they want to do, and that could change over time, and that's okay. But when we were looking at what the financial media is saying, and the additional consternation that they're causing for clients, it's really a shame, because as Steve and I were doing this research, we started last week, kind of finished it up the last couple of days, and my code name for it was "Why a bunch of stuff happened in the market and I don't care." And it sounds very cavalier, and Marcel always kicks me into the table when I say stuff like that, because I mean, I do care what happens in the market, but there's a lot of evidence that suggests that trying to time the market is a fool's folly. It ends up costing people money. Trying to market time, stock pick, both of those things have been proven time and again to cost people money. So it's like, well, why didn't we see this coming? Well, I mean, when people ask me when's the next bear market, I always say, well, we're one day closer to it, like, because I know that it's coming, and that's part of why Steve and I sort of take on the confidence in the market. So it's scary when you see the market swings, and particularly when you look at them in dollar values. You lose $1 million, that feels like a lot, and the thing that you have to remember is, you made that $1 million the previous couple of years because the returns were so good, and unfortunately, the markets they're not consistent. Steve's the real professor. I'm the adjunct professor. But one of the things that I've done in my data analytics class is have the students look at the S&P 500, which has an average annual compound return of 10%. But unfortunately, when you graph it out, it's like, well, how often is it close to 10%? Not very. On an annual basis, you look at it, it's very seldomly is it at 10%. It's up 30, down 20 gets you 10. And it's hard to remember when you're getting, when the market goes down 1 out of every 4 years. Sometimes it goes down a lot. Sometimes it goes down consecutive years. It doesn't usually, but sometimes it does. But it happens all the time. 1 out of 4 years, that's frequent. And you're going to see in a little bit, we've taken a look at, so let me go ahead and share out my screen here.
And while you do that, Brent, I also think it's important to mention when people talk about losing $1 million, for example, we're talking about paper loss, right? So it's not real loss until you sell, which is why it's so important to stay the course, because if you panic and sell, now you've realized the loss.
Yeah.
So that's something that I like to remind people. It's the same if you bought a house for, 500,000, it's worth $1 million, but if somebody comes to you and says, "Oh, I'll pay you 700," you're not going to sell for 700,000 because it's worth more. But you have to wait till there's a willing buyer to pay the price that you're willing to sell it at.
Right. And the beauty of the asset dedication approach, and we'll see that kind of towards the end here when we kind of get into the nuance of how we think about your investments and putting your asset allocation together. But can you see my screen? Is this showing the little cartoon?
Yes.
Okay, great. I mean, this is I think this really sums it up. Is that I was trying to look it up last night. How much ad revenue do any of the financial media? How much do they make? And unfortunately, most of them are part of a larger global media company, so it's hard to split it out. But one of the things that people often forget is that, like, when you've set up your agreement with Marcel and TQM, that agreement is that she is going to act as a fiduciary and give you the best information and help you make the best decisions about your money. The Wall Street Journal, Money Magazine, CNBC do not sign an agreement with you saying, we are going to give you the best information so that you can, particularly specific to you, even, that would be even more difficult, but just the best information to make financial decisions. That's not what they're in the business of. They're in the business to sell advertising. And so the more exciting they make it on a daily basis, the more interest they create and the more they get people to watch or buy their publications or their channel. But that sensationalism makes people crazy, particularly when the markets are going down. And it's unnecessary. It's too bad. I understand it, but it's hard to sift through all of that information because what they put out a lot of information, and a lot of it is people that don't really know but are guessing, and so so I want to kind of take a step back and just look at 100 years of, and we're going to use the S&P 500 a lot today. That's the U.S. large cap. It's the 500 largest companies. The Dow is another one that we have a lot of data on the Dow, and the Dow is performs similarly. And if you have any questions about that, Steve can talk about that a little bit, about the correlations and how close they are. But they're both large U.S. blue chip companies. And when I look at this, so this is on a log scale. So it instead of creating that kind of exponential growth, it flattens it out and gives you an idea of what the actual returns look like. And when you look at this, yes, there's volatility along the way. And what this is, so this is from January, sort of coincidentally, January 1st of 1925 was the start of a bull market cycle that went until the stock market crash in 29. And then and so what this is showing is the red columns are the peak to trough of the bear markets, and the red lines, the red horizontal bars, are the peak to recovery. So we can see that over on the bottom left, it took a long time to recover from the Depression. We almost did, because people sort of forget that it wasn't just the stock market. So there was a stock market crash because there were some shenanigans going on in the stock market. But then there was also the Dust Bowl. There were some kind of poor policy decisions that were made, and there was a world war. And so a sort of lead up to and an actual world war that sort of extended all of this out. And you can see that it almost recovered in late 37. The markets almost recovered, and then they kind of went sideways, down a little bit and sideways. But that was by far the biggest pressure that we've seen on the stock market. We've seen others. So as you kind of move to the right, towards the top, you can see 2000, 2001, 2002. And that one took a while. So that was kind of the dot-com bust. And then we've got '08, which is just shortly thereafter. But you can see the market did recover, but then it went down again. That was kind of the subprime market. And then there's other things in there, right? There's the fourth quarter of 2018. There's COVID. There is 2022. And then what everyone's worried about is where the arrow is. So that's what everyone's having concerns over. And, it's just another blip along the way. I've got another chart that I've used over the years that has kind of the major political events. And it's amazing how many crises there were, right? There's the Cuban Missile Crisis, and there's the Hungarian crisis, and there's the Asian currency crisis. There's all these crises. And really in the end, and you can overlay the presidents as well. And for the most part, the market just doesn't really care. It just tends to go up more than it goes down. And you get this wedge. And so riding through these can be uncomfortable, right? It's not, nobody likes to take the losses, but when we were looking at the main, at the various approaches that we could have taken as we were looking at asset dedication as one of many approaches, what we found was that the cheapest way to hedge market volatility in the end is time. It's cheaper to just use time to wait it out than it is to do anything else. If you overlay options, if you do all these other things, they just end up costing you money over time and don't really accomplish what it is that you want to do. And so this shows, I'm sort of liberal with the term bear market here. This is all since 1925. You can see, we started January 2025. The market went up for 4.7 years. And then we hit the bear market peak to trough. So September 29th, or September of 29 to June of 32. So it was about 2.8 years. It was a big decline, and it took a long time to recover. Sort of barring that one, we've seen a couple that are multiple years to recover. They're multiple years of decline, right? Like you remember 73 and 74, 2000, 2001, 2002. Most of the time, the decline doesn't last that long, but sometimes it does. But we can also see how long the recovery is. And peak to recovery, excluding the Great Depression, we've seen 6.5 years. So that was a while. Took a while to recover from the dot-com bust. And that's really, again, we kind of had two things, right? We had the dot-com bust, and then we had 9/11. And my point with these, and it's why Marcel ends up kicking me under the table and say, quit being so cavalier about it. But it's like bad things happen in the market all the time, and I fully anticipate them and expect them. They happen more often than you kind of think they would if you were analyzing. Steve's going to talk about that in a second here, about how it is that these. If you were evaluating it in kind of a normal bell curve, you'd think like, well, these things would be, you hear about black swans. It's like, well, how come these black swans happen more often? Well, because they do. And we expect them to. It's part of what we studied when we looked at putting together an investment approach for individuals in the context of their financial plan. And it's why, I'll explain why we structure the portfolios the way we do after we let Steve go through and kind of talk about, give a little more context, a little more detail about what's been going on.
Okay, thanks, Brent. That's a good follow-up. Interestingly enough, from a historical standpoint, some people say that crash of 29 led to legislation in the 1930s that essentially cleaned up the stock market and made it much more of an honest game now than what it was back then. There were a lot of shenanigans, as he said, shenanigans going on because people didn't really understand it, and so people began to not trust the stock market, and the to his credit, FDR, Federal Franklin Roosevelt said, we need to clean this thing up because it's really, people are not going to trust it if this kind of thing happens. And so they did. And that's when they established the Security Minister, the SEC, the Security and Exchange Commission there. And it's now an honest game. And every single transaction that happens, there's an audit trail. So back then they didn't have that, but now they have all that. So it's a much more honest situation what it is now. Anyway, getting back to the more recent thing here is my figures went back to 1928. Interesting enough, statisticians and forecasters have never answered a kind of a fundamental question, which is how far back should you go when you're trying to make investment decisions for today and looking at historical data? If you wondered or pondered that question, don't feel bad. Nobody has the answer. There's only two things that most theoreticians agree on. Number one, don't go back any further than where you have reliable data. That's just sort of common sense. And everyone agrees you probably ought to give less weight the further back you go. But exactly how far back, nobody mathematically has been ever able to solve that problem. Some people say, well, we shouldn't go back, as Brent said here, almost 100 years now. If you go back to 1928, and that includes the Great Depression. Well, if you say you shouldn't include that, you're therefore saying, well, there will never be another Great Depression. Well, I would say, as an economist, there probably won't be, but I'm not sure I'd be willing to bet on that because politicians are still politicians, so that sort of hasn't really changed. So therefore, we build a lot of the data going back to 1928 because we do have trustworthy data back that far. The University of Chicago maintains a database that goes back that far that everybody trusts. It's called the CRIS files, Center for Research and Security Prices. And they supply the data that goes all the way back there. University of Chicago hired some graduate students to go back and look at all the old Wall Street journals and all the other media that was reporting stock prices back that far, and they compiled it and is now considered to be a very trustworthy set of data. As a matter of fact, it came out in the 1960s, and there's a film out now about some of the first financial people. They're actually professors at the University of Chicago who began to use that data. And I can send a link to Marcel if you like. It's called Tune Out the Noise, because there's a lot of random fluctuations in the market. And before they had the trustworthy data, no one knew exactly how much to chalk off to random fluctuations and how much was due to other factors. But now with the advent of the reliable data, the whole world has sort of changed a little bit so that we can actually sort of do statistical analysis on the numbers that we can now trust. So I went back and looked, based on what Brent brought up there, I looked at what the best and worst days were going all the way back to 1928. There were 25,520 trading days. That's the whole record there. And you can see it's kind of a boring static thing there. But what I did is I tried to pick out the ones that were the major deviations from the overall average there. Interestingly enough, the single worst day in the stock market history occurred in all of our lifetimes, or at least I think certainly in my lifetime, 1987. Okay, that was the worst one. You can see that the SP went down by just a little over 20%, 20.5%. Interesting enough, that was on the 19th of October in 1987. Interesting enough, a very good day occurred 2 days later when it bumped up by 9.1%. So you can sort of look at this.
Which is about what the market was up again today.
Yeah, no, it's funny how what I think is most interesting about this chart is the fact that the major things that go down, these drops, quite often a big drop, a big upswing goes very soon, a big jump occurs shortly thereafter. So, and that's sort of what Brent was saying, how the market tends to compensate over time. That's where that 100-year chart kind of verifies that that's the case. Where does the little thing happen that occurred on Friday? Well, Friday it lost 6%, and that was a nasty thing. That was the 48th worst day of the 25,000 plus days here. That was the 48th worst one. So there were 47 that were worse than that one over time. And so I just picked out some of the highlighted ones here just to sort of give an idea there what it looks like. If you go to the next one, Brent, can you go to the next slide here? And you have to excuse me. Remember I said I taught statistics? So, so here's the good old normal distribution. There's our friend there. The little blue curve is the normal distribution. If you actually plot the day-to-day changes in the stock market, you can see that it does follow that sort of up and down pattern there. But it's not a very well-built bell because it's too high at the top. They call that positive kurtosis, interestingly enough. And it also has these wings out on the extremes there. And they use the term in the business here in the industry, they use the term black swan because an author wrote a book a few years ago where he talked about these occurrences that happen in the stock market that are more than 3 standard deviations, which have less than in theory, should have less than a 99%, less than a 0.03% chance of occurring. And yet too many occur. You can see these little wings that stick out there. So we have these wild days, and I can use the term black swan because for many years no one had ever seen a swans except for white ones, and they finally discovered them. I think it was in Australia. They found they found black swans sometime, and so they said, oh, they do exist, and so it kind of considered to be kind of a strange event. And there are simply too many black swans, too many strange events that occur in terms of the fluctuations in one day experiences of the stock market. And you really shouldn't see those black swans. You shouldn't see those wings if it was truly normally distributed there. So I couldn't help myself to actually draw that in there. But that's what sort of gives you the idea.
That means. So I get to be always the guy that says, well, after Steve does his professor thing, I get to go, well, what does that mean?
Yeah.
What that means is that we should expect and do expect to see these what feel like really extreme swings. We expect them way, like asset dedication expects to see those way more frequently than I think what the kind of the financial press who don't have the same background and don't do the same research. I mean, when it's actually no surprise that when you find out what most of the folks in the media, what they majored in, it was journalism and not economics. And so, they're familiar with economics and they kind of understand it, but they don't have this, they haven't, steeped in the data in the way that we have. So it's like we see these big swings all the time. The 48th biggest swing doesn't freak us out in any way. It's why it makes it hard to feel like stay the course when you see these big days, but expect them. Know that they're coming, and they're coming on both sides, by the way. And if you want to get the ones on the right side, you have to endure the ones on the left.
That's a good way to put it.
The other thing that I would want to add to this part of the conversation is, what does this mean for our clients today? So, here at TQM, we take what the research Steve and Brent do and what they're explaining and connect it with each client's financial plan. And that's why we're able to show you your critical path, which is something that asset dedication developed as a way to measure how your portfolio needs to perform in order for you to be able to meet your goals. But where I think there's a connection to everything that Steve and Brent are showing us and talking about is there's a historical audit of that critical path. So like Steve said, maybe you don't expect there's going to be another Great Depression. Maybe you do. Regardless, there's been a lot of things that have happened historically that have impacted the market. And we know that in the future, we don't know exactly what they're going to be. Are they going to be, we do know that there are going to be recessions because of economic cycles. Maybe we'll go into another Great Depression. That we don't know. We want to see if your portfolio could withstand things as bad as the Great Depression or as bad as, that downturn in, was it 1987 that you were showing, Steve? That was the worst downturn. So those are the things that we're trying to bring home to you by making, how is this relevant to you? It's, well, what is the resilience of your portfolio? And so that's the job that we have, is by connecting your financial plan to your investment results and to the investment strategy, so that you can expect better results when the worst things happen. In other words, and this is something Brent and Steve and I talk a lot about, which is the mini-max principle, which is minimizing the maximum impact, negative impact that could happen to your portfolio. And I think that's what everyone is worried about today, right? Is this really going to wipe out my portfolio? Well, we've done the work by putting together the detailed, comprehensive financial plan and then matching the cash flows that you need, whether you need them now or in the future, so that we know that the way the portfolio's been built is resilient to these kinds of events without trying to predict the future.
That's precisely correct.
Yeah, well said.
Yeah, very well said. That's right.
We should just record Marcel and have her on our
Right.
website.
Yeah. I don't know if there are any engineers out there, but if anyone is familiar with mathematical programming, linear programming and nonlinear programming, that's the thing that we use to try to utilize that principle of the minimax principle there, that tries to minimize the maximum losses that you're liable to endure, or maximize the minimum gains, depending on how you want to look at it.
So maybe we can shift a little bit into talking about how the asset dedication strategy protects the client's portfolios.
Sure.
You may have some
you
other
can
things
see
you
that
want to cover first. I'm not sure,
Yeah,
but I
got-
want to make sure we get to
yeah.
that.
Oh, we will. I've only got 2 more slides here. So there's just this one, which is the same slide as before, except this one starts in 1987 as opposed to 1928. And it's designed to try to show that the basic pattern has not changed. You still see the same basic thing. Bring up the next one here. This is just more recent data. And you can see it's the same basic idea. Whether you want to go back, 100 years, you go back, 30 or 40 years, you see the same thing happening over, and it's kind of like a rerun of the same movie. So
and we get that all the time. It's, as a matter of fact, I can pull it up.
they always say, "Oh, it's different now." Well,
at my desk, it's different this time.
Yeah,
And
right.
This book is this thick, and it's
Yeah,
just
right.
full of financial data that where people have said, "Oh, it's different this time." I mean, we're all old enough at this point to remember when everyone said, "Oh, the new economy." Well, it turns out the new economy is the same as the old economy, and it's the same as the economy before that. It's like, is it different now? We don't think so, right? We don't think. I mean, will there be changes? Absolutely. Will artificial intelligence help speed things up and make people more productive? Sure. So did the telephone, so did computers, so did the internet. It's not that, so did this, my son's writing his thesis about innovation and managing innovation. And he went back to the steam engine, right? I mean, before that, people were either having to do it manually or having, draft animals pull it. And then all of a sudden you had an engine that could drive machinery. Well, that led to a lot of innovation and mostly was good. And so we see that. But anyway, let me get to all of these, which is when we started our research on trying to figure out how to invest in the context of a plan, we eventually settled on this idea of dedicated portfolios. And dedicated portfolios are really at its core is dedicating assets to the purpose to which they're best suited in the context of a plan. So, for example, cash. What is cash best suited for? If I need to spend money today or in the next few weeks or months, I want to have cash. But I don't need to have cash. I don't need to bury in my backyard 30 years worth of cash. I could do better. However, there are risks involved with each of all the sort of investments that I'm going to talk about. And this is where, when we get to the critical path, we can see how it all ties together. And that was really Steve's concept of a control chart. But at its core, you have a dedicated portfolio where the money that you need to spend this year is in cash. The money that we need over the next several years, we want it to be predictable and stable. And so we use individual bonds, and we also use some things called bullet shares. I don't want to go too far into that, but we use individual bonds timed to match the spending needs. So if you need money next year, the bond next year will mature, and there'll be coupons and other things that are incorporated in that. And that kind of gets into some of the higher math that we use. But at its basic idea, we're going to have bonds that are maturing over time. And in this case, this is what we would call an 8-year income portfolio, where we've got cash for this year, and then the next 8 years, so years 2 through 9, are funded, and we think about this in the context of a pension, right? The spending needs are funded. If you don't need to spend, right? Because not everybody is retired that we're talking to here. Most of you probably aren't. But the nice thing is that this concept still works whether it's a paycheck or a piggy bank. We can take capital off the table. We can take risk off the table and put a buffer in between your money and when you need it. So in the stock market, which is that last big red bucket, that's what funds the majority of your spending initially, right? But we'll see over time how that kind of uncertain bucket is going to work its way down, or as it continues to grow, it really starts to become the next generation's money. And when you think about it, like for my kids should be investing in the stock market. They don't need to have their money in a CD or in bonds. They have lots of time. And as we saw from that wedge, that initial slide that I showed, time is your friend in the stock market. The stock market has returns that it wants to give you for putting that capital at risk. And it doesn't pay you every time, but it does pay over time. And so this is the structure. So we've got cash in the portfolio that's for spending today. We've got bonds. Once you're retired, bonds are going to make that paycheck, but that paycheck isn't going to go forever. And that's because bonds don't yield as much. They're predictable, and so they don't have as high a return. So it's really more of a risk management strategy, and it's putting that buffer between today and when I need to sell stocks. And if the market's doing great, it's a great time to sell stocks, and I can buy a longer buffer. And we'll talk about that here in a second.
Yeah, I might point out that he's got the 9-year there, but typically the length of the what we call the income portfolio there can be anywhere from 5 to 10 years. There's no fixed thing there. He's just using
Good
that
point.
9 years as an example.
Yeah, that's right. There's no magic. I mean, we have them as short as like I think 4, and we've done one as long as 27, which was in my view way too long, but it served its purpose.
The other thing I would point out there, Brent and Steve, with the buckets is that is what determines your asset allocation.
Correct.
Right. So it's not that there's a, rule of thumb that says if you're 60 years old, then you should be in a 40-60, or if you're 50, you should be 50-50. No, it's dependent on your cash flow needs.
Yeah.
And then how long the income dedicated portfolio is going to be, which will determine how much will be in that portfolio. And then whatever isn't in the income dedicated portfolio will be in the growth portfolio. So that's where you're getting your allocation.
That's correct. And that's and I know you know this part really well, Marcel, is because you do a lot of that really high end planning where you've got people who are deferring. So they've retired, but they're deferring Social Security and doing Roth conversions. And so they may have their bond allocation might be kind of high initially.
Yeah.
Until the Social Security comes in, and then that takes the pressure off the portfolio, and the allocation will shift over time.
Yeah.
But they really are sensitive to, like, if you've got money in the market, but you don't have a very long bond portfolio, but you're spending, sort of proportionally higher initially because you're not taking your Social Security. you may have a higher bond allocation, but that provides a lot more cover for these volatile markets, right? Because who knows? We don't know how long this one will go down for, but we've built this concept knowing. I always say it's like we're kind of like Eeyore from Winnie the Pooh, who only thinks about the bad things that can happen. We're like the Eeyore of money management because we've built the strategy so that we could be resilient through bad markets. Good markets are great. We're going to do fine. Everyone's going to do fine. But can we do things on the front end before the bad markets happen so that we've got the structure in place so that when they happen, we can just ride through it and we don't have to worry. And there again, that's where, if you're in retirement, sure, you've got that income portfolio as the buffer. Um, and and if you haven't retired yet, you've got just actual time, but a lot of times there people will want to build a kind of a piggy bank buffer. So it's like, even though it's not designed to spend, it's kind of building that paycheck early so that when you retire, you've already got it in place. So you're just kind of front loading that. The critical path is something that Steve developed to drive what you'll see in a minute here is that what we call the roll don't roll decision, and it's where we use the financial plan. And so this one's like super smooth. The white dotted line is where your portfolio needs to be in order for your financial plan to work out. Now I know I've seen it particularly with Marcel's clients that nobody's got a real smooth one like this. They're always jaggedy because it's like somebody's deferring and then they've got deferred comp, and then they retire, and then they sell a building, and then there's all these bumps and lumps in their curve that makes it not just this like super easy smooth curve. But it doesn't matter what the shape of your particular curve is. What matters is that we now have a tool to make decisions about your portfolio and what to do, and we already know what to do before it happens. So if I'm here, I'm overlaying that bucketed portfolio. And I use the buckets. We're not really technically a bucket portfolio, but we're kind of close. And a lot of people have heard of buckets, so that's why I used them. But here is someone's 30-year financial plan. And let's say they're already retired. And if they're not retired, then they're still saving, and maybe they're taking some out of their portfolio, maybe they're not, because maybe they've sold a business and they're taking some money because for lifestyle, but they're still not fully retired or whatever. It can take lots of shapes, but I'm just going to keep it simple in this case. Retired, 30-year financial plan. We've got that first year in cash. We've got the next 8 years in bonds in that income portfolio. And so those bonds are predictable. The day that we know them, we know how much they're going to mature for and how much the coupons they're going to pay along the way. So it's very predictable. There are some risks of default and things like that, but we're using extremely safe, CDs, government agency bonds is sort of our main go-to. And municipal bonds for people where the income bracket makes sense. So we've got 8 years of income in that bond portfolio. And then we've got 21 years that we're funding, right? We're using to fund the next 21 years in that growth portfolio, in an equity portfolio. I'm not going to go into too much detail as to which asset classes we pick for which reasons. And that's really where Marcel kind of works with you to kind of navigate how long, how do you feel? It's like some of it is a behavioral issue and some of it is just, which asset classes are best suited for your horizon. But we put a lot of work into that over the years, but I don't want to get too far off track here. But when we've got this structure, right, so the market just went down, the last couple of days, and really so far this year, market's off this year. But I still have the cash that I have for this year, the next 8 years of bonds. And so I'm 9 years out. We've got 9 years to go through, and we saw most of the time the markets recover in a couple of years. Sometimes it takes longer, but I've got a lot of cover. I've got a lot of time. And so even if I'm not retired and I've just been building an income portfolio so let's pretend that You've built out an income portfolio, but it's a piggy bank and not a paycheck, and then you get laid off. I mean, it's like for most of y'all, it's like you have your own business and whatever. But let's just pretend that you get laid off tomorrow. Well, then you actually have that bond portfolio that could turn into a paycheck immediately and could cover your spending needs. And so even then, you don't have to worry about the liquidity shocks in the stock market right now. They go down, they go up. And what we want to do is we want to be systematic about the way that we do this. And so
Yeah, Brent,
oh, yeah, go
Brent,
ahead.
what if somebody had an export business and new tariffs came along? Do you think that ever happens?
Yeah, it's probably happened.
But one thing I'll add actually is, aside from what you're seeing here, part of the financial plan is also saying, well, what are the reserves you need? So if, let's say, for just to use Brent's example, you do get laid off, and we've built an income portfolio, but that, unlike this picture here, is going to start with maturities 5 years from now. And so that's why we build also a reserve.
Yeah.
And the reserves don't need to be in a savings account. They can be in a money market with, a 4 to 5% return. But that's part of the, connecting the financial plan with the investments and what's really going on in people's lives, or what can happen.
Buying time, right? I mean, that's essentially what we're doing, is we're just trying to buy time, knowing that market volatility is coming. We don't know when it's coming. So we're going to put this structure on the front so that we don't have to do anything at the wrong time. And that's really, ultimately what the webinar today is about, is, we don't have to do anything at the wrong time. I'd say that, Steve and I don't believe that there's anything structural in the market that is going to make it go out. I don't think that all 500 companies in the S&P 500, for example, are going to go out of business.
And there are many more than 500 companies in the market, but that's just an example.
Because our most popular portfolio has 12,000, and they're all across the world. So unless the global economy goes out of business, we'll probably be just fine, right?
But I do have a question from one of the clients.
Sure, go ahead.
That I think the answer will be interesting, because the client is saying, it seems like Washington is leading the country into a recession affecting everyone. I noticed already an increase in prices, and I think this will continue. What would Washington gain leading the country to a recession, and how would they make things right? And the reason why I think the answer to this question is interesting is because we are not politicians, but instead we are financial planners, economists, investment managers. If we do go into a recession, this is exactly what protects you. Right? So,
and we go into recessions all the time.
Yes.
And that's the other thing. It's like, we know that recessions are coming, and recessions don't always coincide with market declines. Sometimes they do. Lots of times they do, but they don't always. But they're going to happen, right? We're going to see that happen, whether it's self-inflicted or not. They're just a fact of life. And so, so I'll stay out of the policy side of it, and say that, we've had politicians make good decisions and bad decisions, and that market still continues to grind forward. And most of the time, I mean, it cares a little bit in the short run, but in the long run, what drives the market is that new ideas grow faster than old, tired ones die. And so, like, I don't know, like in the 1980s, Kodak was one of the largest companies. It was the seventh largest company in the world. It's not anymore. It's been broken up. It's been broken apart. But Google and Microsoft and NVIDIA have grown faster than Kodak has fallen apart. And that's going to continue to happen, right? That innovation, unless there's unless we stop innovation, that's going to happen. politicians are going to come and go. They're going to make good decisions. They're going to make bad decisions. And, you know, sometimes they make decisions that the textbook would say this is the thing to do, and it doesn't work out that way. And other times they make decisions where everyone goes like, oh, you're absolutely crazy for doing that, and it works out. So I think we just have to sort of stipulate that people are going to be people, and they're going to make good decisions, bad decisions. Sometimes we'll agree, sometimes we won't. But in the end, it won't really matter because the market's going to continue to drive forward, independent mostly of what people do, good or bad. What do you think, Steve? Did I nail that?
Yeah,
Did I get full
yeah, I
credit?
believe. Yeah. No, that's absolutely, well, that 100-year chart demonstrates that that's the case. You know, that's going to happen. And the impact of these tariffs, you know, they could lead into a short-term recession. That's entirely possible. I was trained as an economist. We were all trained that tariffs are bad, and everyone agrees that. Trouble is, the world economy as it exists now has thousands of tariffs. They're interfering with the free flow of goods and services around the globe. And in theory, if we had zero tariffs for everybody, the entire world would have a much better economy. But because we do have so many tariffs, everything gets kind of distorted. Now, I'm not sure what else Trump could do in order to get people to stop theirs. And he claims they're reciprocal tariffs. I assume that what he means is if you drop yours to zero, we'll drop ours to zero. If you keep yours up, we'll keep ours up. And I think it's kind of a card game here as to how else is he going to get them to drop their tariffs. I think, you know, in terms of negotiation, they've already tried to ask nicely, and the other countries say, nope, sorry, we're not going to do it. So how else would he, you know, I'm not sure what other cards he has in his hand that he could play to try to get them to stop their tariffs. And the only I can see is at least what he said is that, you know, they're reciprocal tariffs. If you put tariffs on the goods that our people produce, we'll put tariffs on the goods that your people produce. If you stop yours, we'll stop ours. So, and I understand why the tariffs were developed originally after World War II. Europe was in a shambles. They needed to have, you know, ways to start to build their factories and all that sort of thing back up again, and they needed the help. But, you know, I was
Been a
born during
while.
World War II, and it's been a while. It's
It's
been
been
a
a
while,
while.
you know, 80 years here since the World War II has been over, and so seems like the tariffs should have been gradually tapered off. You know, I'm surprised they didn't do it more when the European Union was founded. But you know, and they stopped a lot of their own internal tariffs there in order to become a form, just like we don't have tariffs going from state to state. They did away with that there, and sure enough, it paid off for the European Union that it's grown faster since they stopped all their internal tariffs, and that same principle would apply to the entire world. You know, so
So
anyway.
we only
Oh,
have a few minutes left. I want
Yeah.
to
oh,
make sure
sorry.
we
Yeah.
cover the most important parts for our
So
clients in terms
so
of how to help them stay calm during these turbulent times.
So one thing I just wanted to show was, if it's okay, I'm just going to kind of show the mechanics of the roll, don't roll, Marcel.
Yeah, absolutely.
And the reason I'm going to show that is, you know, like once you've got your income portfolio in place, right? You've got 8 years of income. Like, why did we do that? And we didn't like so eight. And as Steve mentioned, there's nothing magical about 8 years here. Like in our book, we use 10, and you know, the average is actually 9, but no one ever does a 9. They do 8s and 10s, and then so, um, but nonetheless, you know, if I've got an 8-year income portfolio and a year goes by, right? So now I only have 29 years of that financial plan uh, left to fund because 1 year's gone by and I had the cash, I spent it, and that bond in year one came due, and now it's cash. So I now have the cash that I need to spend for the next year. So I didn't have to go and sell anything out of my portfolio, and I didn't have to sell my. You know, we use a lot of mutual funds on the equity side. I didn't have to sell any of my mutual funds on the equity side. And on the bond side, this is the distinction. Um, a lot of financial advisors will use bond funds because they're easy and they're generally stable. But the problem is, and we saw this uh, in 2008, in March of 2020, in 2022, in the fourth quarter of 2018, in all of those down markets, the bond market was down too. And so if you had to sell, if you just had to systematically withdraw, is what they call it, and sell something, you were in trouble because it was like worst case reverse dollar cost averaging, right? Something was down, you had to sell it, you had to sell more of it to have enough cash to spend. But with the individual bonds, they mature and give you your money back, and we know how much the day we buy them. However, so now we've gone from 8 years to 7 years, right? And so now we only have 7 years of that where we can continue to ride out bad markets. And the reason the critical path exists is because we have to determine, should we roll or not roll, right? Do we move those arrows out, right? Do we shift and sell stocks and buy bonds or not? When the market is down, we don't. The whole reason that we had those 8 years, like, so if we were above our critical path, right? So if we're spending what we're supposed to spend and the markets did pretty well, then we would extend that portfolio back out, right? So now we'd have 29 years, we'd have 1 year in cash, 8 years in bonds again, but now we only have to fund 20 years with the equities, right? And so we're sort of systematically, and we're, paring down that uncertainty on the tail. But the whole reason that the income portfolio exists is if the markets have been bad, or if you've overspent. I mean, you can spend yourself into this situation as well, where you need to give the markets time to do what they're going to do, but they're not doing it this year. Then you just go from 8 years to 7, and then another year goes by, and then you're at 6 years. You still have 6 years of income, so you still don't have to panic sell. And that is the real secret there, is that we're just putting time so that we don't ever have to worry about what's going. That's why, Marcel kicks me under the table because I'm so cavalier about it, because it's like, we don't have any clients who have money in the market today that they need tomorrow, or that they need in a year or 2 years. Now, if the markets are great, fantastic, then we'll take it off the table. And that's what the critical path helps drive that. It's like, if the markets are going really well, we're going to continue to expand that income portfolio. And maybe we go from 8 years to 9 years to 10 years. And then we just buy more and more time. So if I'm conservative, I'm worried about what the market that makes me crazy, I'm just going to want a longer income portfolio. But bonds are kind of expensive relative. They're an expensive way to fund it because they have that predictable nature to them. So, there's a lot less risk in them. So there's also a lot less reward to them. And but they are just perfectly suited. Individual bonds are perfectly suited to providing that cover, so you don't have to worry. So it's like, you can look at what's going on in the market and it's like, oh, it concerns me. But 15 years from now, will you care? Like, I can tell you right now that huge drop in 1987, I have to try and remember when that happens, because when I think of 1987, I think of my acid wash jeans, my topsiders, and my flock of seagulls haircut, not not this big decline in the stock market, because the market has fully recovered like multiple times since then.
Right.
And it will, in our view, it will continue to do that. These tails happen with regularity. We expect them. We've built a structure of a sort of portfolio management structure where we can insulate ourselves for not forever, but for really long periods of time, most of the time, more than we need to recover from the bad markets.
That's great. Thank you very much, Brent. Steve, do you have any final words, or Brent as well?
Well, I think Brent did a good job of trying to present the whole idea behind the strategy. It's designed to try to help in precisely the kinds of situations we have right now. That's why we have it. So it was just that portion of your portfolio is dedicated, and it's immunized, it's insulated against that kind of impact. It's like you got a wall that's 8 years thick, between you and having to really do anything. So
Yeah, and I would just add, as my final words, that investing is very much like meditating. We get very distracted with things that are going around us. But in meditation, they say, listen to your breath, pay attention to your breath. And in investing, I say, go back to your plan, focus on your plan, look at your critical path, and that'll keep you focused. One final question from one of the participants is, does the traditional 60/40 portfolio strategy still hold up in today's environment, or should investors consider timing the reset by moving opportunistically into safer assets, then dollar cost averaging back into equities as the recovery takes shape?
That
So
sounds
I,
enough. Oh, go ahead.
well, I would say that the 60/40, we get compared against the 60/40 all the time. When you do what we do, the asset allocation floats around, and it floats around to try and continue to give the portfolio the better chance of matching the spending needs. I would say that it's actually timing the reset is just the opposite. What we wanted to do last year, so last year was a pretty good year in the market. That was a great time to sell your winners and extend your income portfolio when the winners are up, and buy more time so that you can ride through a even longer market disruption. And so what they've seen is that the timing, sort of moving into safer assets now, you're going to eat the loss. Market dollar cost averaging back in, it's like if I jumped out on Friday or yesterday, I would have missed today, where I'm up 9%. Did anyone predict that it was going to be up 9% today? Maybe they got lucky, but I will say that most people that make their market timing claims are get lucky once and talk about that all the time, and never are able to replicate it in any kind of systematic way, sort of like the blind squirrel or the chimpanzee throwing darts or whatever. So if you just ride it back out, it's what we've tested, right? Because we tested this stuff, because his question is a good one, right? I mean, that's what a lot of times people do. And so, we need to test that. And when we test that, any of the market timing signals that we tried, even if you use the ones that are like Meb Faber has got these trend following ones, and I built out a trend following portfolio, and it did what you'd want it to do when there is an absolute market meltdown. The problem is that it runs into problems all the time where it's not really a market meltdown, it's just a little blip. And so it ends up selling out after the blip is kind of triggered, like it's time to sell. And then you miss that, like day like today, like that 9% bump up. And then you jump back in, and it's like you ate the loss, but you didn't get the benefit of the recovery, because you were trying to, systematically do a dollar cost average back in, but you'll probably miss the days. And so as bad as it feels, like it feels more like you're doing something, right? When you kind of move to safer assets and you dollar cost average back in, it feels like you're doing something, and that you made the portfolio safer. You may have made it less volatile, but you won't end up with more money in the end. That's kind of I don't know, Steve, you got anything to add there?
No, you're kinder about the 60/40 portfolios than I am, but I was never able to have anybody ever explain to me scientifically exactly how they derive that. You
Oh,
ask them specifically, statistically, and and they'll say, well, blah, 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 blah. You hear some vague answers.
no, I can tell you, I found the initial research. I found the origins of it.
Oh, you
And
did?
it's brilliant. Yeah. And it has no scientific backing whatsoever. One of the large 401k consultants just took the average asset allocation of the 30,000 participants that they were analyzing, and their average asset allocation was 60/40. And so they went, there it is. So all of the people who know, almost, the vast majority of them know nothing
Right.
about the stock market. They just took an average of just all these regular people,
Right.
and that's where 60/40 came from. It was
Right.
actually, I found that, I forgot to share that little tidbit with you. I
Oh,
saw
yeah.
that the other day.
There was a time when everyone thought the earth was flat too, you know,
Yeah,
so.
right.
Well, thank you very much, Brent and Steve, and for everyone who was on the call this evening, or for anyone who's watching this recording. Please feel free to reach out to me or anyone at TQM Wealth Partners, and have a good night, everybody.
Thanks, Marcel.
Thanks.
Thank
Thanks.
you.
Thanks.
Bye-bye.
Bye.